What if I tell you there's a best way to invest your money with banks here in Canada? Because I know you never heard about this. I know a lot of Canadians actually love their banks and tend to invest in individual banks and put a lot of their money in there. But there's a lot of volatility with these banks. There's a better way to invest your money with banks in Canada. And that's what I'm going to show you here. So this is Hamilton Enhanced Canadian Bank ETF. If you look at the ticker symbol, is HCAL. Yield is 5.10. I'm going to show you here this yield compared to the banks. If you look at the highlight of this ETF, yield of 5.10 paid monthly, equal weight exposure to Canadian big six banks with modest 25% leverage. HCAL has similar volatility compared to the big six Canadian banks. Who is a good fit for? So if you're an investor who is looking for enhanced growth potential, so you want growth and your money to enhance, meaning you have that 25% leverage embedded into this ETF or into your money you're going to invest, a higher monthly income, and you have modest 25% cash leverage, as I've mentioned before, because this leverage would allow you to get more income, because the regular banks, if you invest in a regular ETF, a regular stock, you're not going to receive more money, because we know a lot of banks, they are between 2 to 4%. This one you get 5.10, and most banks pay a distribution every quarter, every 3 months. This one you get every month. So this is very important because it will accumulate your money and compound faster, because if you compound monthly, you are compounding your money at a faster rate than compared to every 3 months. Now, the fund objective, HCAL is designed to track 1.25x the return of selective equal weight Canadian banks index, investing in Canadian banks using modest 25% cash leverage. HCAL does not use a derivative. So this is not synthetic cover call ETFs. It invests directly in 6 Canadian stocks. And of course, they use that leverage 25% to enhance. So for people who don't understand how they use that 25% leverage, is like, for example, if this fund, HCAL, has 1 million invested in this ETF, they're going to have 250,000. It's like a borrowing money. They're going to add it to 1 million. Now you have 1 million and a quarter. Imagine you're investing only 1 million, but you add 1 million and a quarter. That way you're going to generate a lot of more income than just having 1 million. That's how they use that 25% leverage. But this is a technical way they're going to do. You really don't have to know more details about that. Of course, this makes your fund to be a little bit volatile, but at the same time, you're going to receive higher distributions. But you'll be surprised what I'm going to show you next. Now, if you look at the performance of this ETF, NAV first, this is a price of today, 30.61. Okay, yield of 5.10. Within 8 months has returned 8.30%. 6 months has returned 16.30. Within 6 months has returned 24.53. Year to date has returned 25%. So from January to now, this ETF has returned 25.2%. This is very, very good. I think is more than the Canadian market. But if you look at 1 year, this is September last year to today, has returned 42.30%. Very impressive. Now, since inception has returned 21.91. So this is average annual return about 22%. Very impressive. If you're making this money every year, you're making 22%. That's very, very good for bank stock. Now let's look at the stock chart price. If you look at the red one or maroon color, this is HCAL, this ETF we're talking about. And then the darker gray, this is Canadian Bank Index. So if you combine all the banks together, this is their performance. This is not individual banks. For example, if you invest in a BMO, you could have made more money than this ETF. But on aggregate, if you take all the banks together, their index, if you invested $10,000 in 2007 to now, your Canadian Bank Index would only be in 64,500. With this ETF, if you invested within the same period, then your portfolio right now from $10,000 without adding any other money, you just reinvest your dividends, then you'd have almost 92,000. That's very impressive. And on your right hand side here, it shows you a volatility comparison. So the red one, HCAL here, is 16.6, BMO 18, Bank of Nova Scotia is 16.5, CM, Canadian Imperial Bank, is 17, National Bank is 16.9, Royal Bank is 14.7, TD 16.8. So the only bank that has lower volatility than this is Royal Bank and Bank of Nova Scotia, but the rest are a little bit higher than this ETF. So even though you have that 25% leverage, but your volatility is pretty low. And for people who don't understand what volatility is literally a gauge comparing how much volatile your stock is as compared to the rest of the market. So the higher volatile is when your stock goes up and down so fast and most people panic and try to sell. And lower volatility is a stock that does not move that much, but those stocks or ETF tend to not do well in terms of performance. Now let's look at the top holding for this ETF. As I've mentioned, this is an ETF that invests in 6 Canadian banks. So you have Canadian Imperial Bank of Commerce, CIBC, 17.8%, Royal Bank at 16.7%, Bank of Nova Scotia 16.6%, National Bank of Canada 16.5%, Toronto Dominion 16.4%, and Bank of Montreal 16. So the idea here is equal weight, and based on the performance of these stocks, then of course one is gonna outweigh the other ones. But end of the day, every now and then managers of this ETF will go and rebalance these ETFs. If we look at the ticker symbol is HCAL, it trades on Toronto Stock Exchange. It was incepted October 14, 2020. Asset under management as of now is closer to 700 million. Current yield 5.10. It distributes monthly, and management fee is 0.65. This is how much you're paying to invest in these ETFs. So for example, if you have $10,000 invested in this ETF, every year they're going to be charging you $65. So it's very low as compared to how much you're getting, and plus growth. Risk is high because it has a 25% leverage, and you're investing in only one sector because you only invest in 6 banks. There's nothing else. There's no energy. So it's high because you're concentrating your portfolio, but the growth potential is also higher. Now, if we look at the distribution history, they've been paying distributions for quite some time since they came out. But what I'm interested is to see how much they paid when they started. If you can see here, it started only about 8 cents or round up to like 9 cents. And if you come to the next graph, it increases, went to 10 cents. If you go to next time, they increased from there. If you go to 5, they increased to 10 cents. Then it went to 11 cents. Then it went to 12 cents. So they keep increasing, which is very good. Right now, they pay about 13 cents. The last distribution they paid was yesterday, September 8th, 2025. And they paid about 13 cents round up. So guys, I just made this video to show you how you can invest your money in banks without having to own individual banks. Rather, you can just own an ETF like this one, HCAL, and you can have substantial growth. On top of that, you're going to have 5.10% yield that you're going to receive every month, and you can reinvest your money back to the stock, and that way you're compounding your money faster. So if you have any question, make sure you leave in a comment below and let me know, are you interested by this ETF? And if you are not interested, which other ETFs are you looking at? That's all I have for today. If you like this type of content, please make sure you subscribe to this channel so you don't miss any of the new updates, and also smash the like button and share with someone you think this video may help. Thank you very much for watching. I'll catch you in the next video. Bye bye.